when it comes to doing T accounts, the confusion arises first off to why you're doing it, which is not an unrealistic question, but also as to what side they go on. Now, as I mentioned, with the template I give you, it's going to include the name of the account, the classification of the account, current asset, fixed asset, CAFA, whatever it might be, and it's going to have the total. So the T account I give you is going to say cash, CA, and because it's a current asset, you can see here, it's going to be on this side. So the total will be there. So you don't need to understand what side the increase or the decrease is on, because once the total is on this side, then you know that the increase is on this side. Now we have debit and credit, of course, which can be related to this. I mean, well, I'm not so heavily focused on that because kind of like the way that the T account is becoming a little obsolete, just a way of learning accountancy, debit and credit is becoming a little less significant in its definitions as well. But anyhow, the purpose of the T accounts is to try and generate an understanding of how the accounts are put together. And when you're doing the T accounts, if you're in any doubt as to what side the T accounts go on, I mean, like in this case, the current assets, it increases on the debit side or the left-hand side. And the reason it increases on the debit side or the left-hand side is when you look at this as a general formulation of the income statement and the balance sheet, you can see what is on the debit side or the left-hand side. And any account that falls under these categories, say in this case current assets, is going to increase on the debit side or the left-hand side. Conversely, if we have our current liability or our sales, for example, sales will always increase on the credit side or the right-hand side. And because they're on the credit side or the right-hand side of the income statement and the balance sheet, taking these as the general key headings that you are likely to encounter. So once you can understand that this is why they're on this side, they match according to this. Cost of goods sold will be just like this. Service costs like this. Running costs like this. Fixed assets, current liabilities, long-term liabilities, capital, they'll all be accounted for on the right-hand side, credit side. Now again, when it comes to understanding debit and credit, I'll give you the document for that. But as I said, it's somewhat an obsolete kind of understanding at this point. It's not likely to be something you're going to encounter, especially as managers as opposed to, say, accountants, but even within the accounting industry. But when you look at all of these, the items, say on the debit side, this is like the debit, not being credit. You can see that from a cash flow point of view, now this is all related to what gives us money to spend. You can see here that the cost of goods sold, service costs, running costs. So these are costs that we have either incurred or we've actually paid. And then there are fixed assets, we've got buildings, cars, accounts receivable, and bank or cash. Now all of these technically have been uses, are disposals of income. I mean, from a cash flow point of view, we have actually had to use money in order to generate these assets. And that is what we like, is the debit side basically. Anything that we have used, or any source of money, but where we have actually disposed of or had to negatively impact our cash flow from a business point of view. On the other hand, when we talk about the credit side, you can see that sales, obviously sales generate money, as would an investment income, an income not that the owners give us, but an income that we generate ourselves by using money from the company. Current liabilities. This is where the confusion really comes. How can current liabilities and long-term liabilities and capital possibly be seen as us doing it? Now this comes back down to, say, liquidity. But an account payable is technically seen as us being efficient in using our cash. In fact, if we are not, we're getting the goods in and ideally selling them before we need to pay them. So that we're a cash conversion cycle, which we haven't really spoken about, but is actually very, very, very good for us. So this is actually considered to be a positive thing, as in we have got the goods in, but we haven't actually spent money on them, so this is positive. Loans, we got money in, but we actually haven't had to pay it back yet. Again, this is what we see as cash flow positive. Same for the mortgage, the capital. All money coming in that we haven't had to pay back yet. So we're using other people's money to generate income. So this is what we see on the credit side. Now, as I mentioned before, the definition between these two is not that important. When we talk about the T accounts, we talk about debit and credit, you're not likely to be sitting there thinking about, well, is this actually is this a use or a disposal of income, or is this a generator of income? You're going to be thinking more along the lines of what side does it go on, which is perfectly reasonable. And the quick answer to that is, using this kind of template, anything that is on the left-hand side or the debit side will be accounted for on the left-hand side or the debit side. Anything on the right-hand side or the credit side will be accounted for on the right-hand side or the credit